I learned the hard way that the market always whispers before it ever shouts. Years ago, I misread a quiet trading range in a copper campaign, assuming the lethargic drift meant the campaign was dead. I sold my position out of boredom just hours before the first true signs of accumulation revealed themselves. What I took as aimless wandering was actually the market's mind forming a clear pattern, subtle shifts in volume, tightening spreads, and a sudden refusal to make new lows. That one mistake cost me a fortune, but it taught me the truth. The market repeats its intentions in recognizable footprints long before the public sees them. If you can learn to pick up those simple, recurring patterns, the ones hidden in the tape and structure, you gain something priceless, the ability to read the market's mind before it makes its move. The market has a peculiar habit of disguising its intentions in plain sight, yet it never truly hides. It repeats itself with almost stubborn consistency, offering the same clues, the same footprints, the same structures that have appeared for decades. The trouble is not that the market is unpredictable, it's that most traders haven't learned to recognize the repetition. They wait for something magical or mysterious, when in reality, the market speaks in simple, recurring patterns. Once you've seen them clearly, you'll notice that the market behaves more like an old actor performing the same script on a new stage. The props may change, the audience may grow larger, and the costumes may look more modern, but the storyline remains identical. Early in my career, I wasted countless hours searching for new indicators, new systems, and new secrets, thinking I needed something sophisticated to understand market behavior. But time eventually forced me to confront the truth. The market didn't need new interpretations, it needed a clearer observer. The repeated structures were already in front of me: long periods of dull, directionless movement where professional money quietly accumulates, sudden expansions in volume that reveal hidden interest, steady advances masked as randomness, and climactic surges where the public chases the last stage of a trend. These weren't anomalies. They were foundational patterns that have existed since the first exchanges were built. The beauty of these patterns is not just their reliability, but their simplicity. You don't have to guess what the market is thinking when it leaves unmistakable signs. When price stops falling despite heavy selling pressure, something is shifting. When volume increases yet price barely moves, control is changing hands. When a trading range forms with well-defined boundaries that price refuses to violate, a larger intention is taking shape beneath the surface. You start to see the market not as a battlefield of random forces, but as a sequence of phases: preparation, movement, pause, reversal, and repeat. Over and over again, recognizing these recurring structures does more than improve technical skill, it reshapes a trader's psychology. When you internalize the fact that the market's behavior is patterned, not chaotic, your anxiety diminishes. You stop reacting to every sudden spike because you know spikes happen for a reason. You stop fearing trading ranges because you understand that they are the birthplace of major moves. You start expecting the market to behave according to its own logic, not your emotions. And when your expectations align with the market's natural tendencies, your results become more consistent. The difference between a struggling trader and a skilled one often comes down to this: the struggling trader sees every chart as a new puzzle, while the skilled trader sees every chart as a familiar storyline. When you learn to recognize the market's recurring structures, you gain an advantage that has nothing to do with prediction and everything to do with understanding. You're no longer guessing, you're reading. The market becomes less of a mystery and more of a language. And once you speak that language fluently, you don't just trade better, you trade with confidence, precision, and clarity. Most traders deceive themselves into believing that price alone tells the whole story. They chase every breakout, panic at every dip, and celebrate every green candle as if it were a revelation. But the truth is far more subtle. Price is merely the surface expression of a much deeper struggle. The real intention of the market, whether it is preparing to advance, retreat, or trap the uninformed, reveals itself long before price makes its dramatic move. It shows up in the relationship between volume and spread, the very heartbeat of the market's internal activity. Those who learn to read that heartbeat gain a decisive edge over those who only watch for obvious signals. Early in my development, I made the same mistake most traders make. I saw a rapid price surge and jumped into the move, assuming the market was finally waking up. But had I paid attention to the preceding bars, the shrinking spreads on rising volume, the refusal of price to decline despite heavy attempts, I would have realized that the true shift had begun far earlier. The big operators had already positioned themselves, while the surface looked dull. The surge I thought was the start was merely the public recognizing what professionals had already acted on. I wasn't early. I was late, and that lesson burned itself into my trading memory. Volume and spread never lie. When volume expands yet price barely moves, it signals that a powerful force is absorbing supply or distributing stock. When spreads tighten but volume rises, it often marks the quiet preparation before a significant move. When volume dries up entirely, it can indicate either exhaustion of selling near bottoms or lack of demand near tops. Each variation paints part of a larger narrative. Together, they reveal the market's intention with uncanny clarity. Consider a typical accumulation phase. The average trader sees dullness, stagnation, boredom, but in reality, that dullness is the result of deliberate activity, strong hands absorbing everything weak hands are eager to sell. Price doesn't rally yet because the preparation isn't finished. But if you look closely at the volume, spread relationship, the clues are unmistakable. Decreasing intensity on down waves, stronger closes on even modest buying, and abrupt surges that fail to push price lower. These are the whispers of strength that precede every major advance. Similarly, at the end of a long uptrend, the story reverses. You'll witness increasing volume on wide spreads that fail to make meaningful upward progress. Demand appears strong on the surface, but the lack of follow-through reveals a different truth. Someone is unloading inventory into the excitement of the crowd. Again, the message is in the volume and spread, not in the price alone. Once you shift your focus from isolated price bars to the underlying effort versus result relationship, your entire perception of the market transforms. You no longer chase moves, you anticipate them. You no longer fear volatility, you interpret it. The chart stops being a battlefield of confusion and becomes a detailed map of intention. When volume and spread reveal the market's true motives, you stop reacting to price and start understanding it. And that understanding is what turns observation into mastery. The greatest losses I ever took were not from bad markets, they were from bad interpretations. I used to fixate on every sharp drop, every sudden spike, every dramatic candle, as if the entire fate of the trend depended on that single moment. That kind of tunnel vision ruins traders. The market doesn't reveal its real intention in isolated events. It expresses itself through a continuous narrative. A single candle is noise. A sequence of behavior is a message. When you learn to read the story, not the fragments, you begin to understand the difference between randomness and intention. In my early years, I recall reacting impulsively to what looked like a violent sell-off in a commodity I had been tracking. One sharp down, bar caught my attention, and without thinking, I dumped my position in fear. The very next day, price snapped back with a level of strength that made my decision look foolish. What I mistook as the beginning of a breakdown was nothing more than a shakeout, a deliberate attempt to mislead weak holders. Looking back at the larger context, the signs were clear. Demand had been building, selling pressure was diminishing, and the structure beneath the surface remained intact. I reacted to noise and ignored the story the market had been telling for weeks. That mistake cost me not just money but confidence, and it taught me a lesson I never forgot. The market must be read as a whole, not as a series of disconnected events. The market tells its story through phases: preparation, movement, testing, exhaustion. If you only focus on the dramatic chapters, you miss the setup that gives those moves meaning. A surge in volume at the top of an uptrend means one thing. The same surge near the end of a trading range means something entirely different. A wide spread during distribution carries a different intention than a wide spread during accumulation. The trader who reacts to these events without seeing what came before or what the structure suggests will always be led astray. True mastery comes from building the habit of contextual reading. Each rally, dip, spring, test, and spike is a sentence in a much bigger story. You must read it the same way you would read a book, not by staring at individual words, but by understanding how each sentence contributes to the theme. The market's narrative is formed by the relationship between effort and result, by the direction of force, by the shifting balance between supply and demand. It is a dynamic story, but not a mysterious one. Once this shift in thinking happens, trading becomes far less chaotic. You stop feeling the urgency to react to every bar. You stop fearing volatility because you see how it fits into the structure. You begin to anticipate rather than chase. You observe rather than participate in the panic. The noise fades because you've trained yourself to listen for the underlying message. And that is where consistency begins, not with predictions, not with indicators, but with your ability to read the unfolding story the market is constantly writing. One of the greatest turning points in my development as a trader was realizing that price structure is not decoration on a chart. It is the blueprint of the entire campaign. Before I understood this, I traded like most novices do, reacting to every move, hoping trends would continue, fearing every reversal. My trades had no anchor because my decisions had no structural reference. It wasn't until I began studying how markets move in phases, how each campaign forms identifiable architecture, that everything became clear. Structure is the map. Ignore it and you trade blind. Early in my career, I would often enter trades in the middle of nowhere, no clear support below, no resistance above, no logical reason for price to turn or accelerate. I was trading emotions, not structure. The market punished that behavior relentlessly. It wasn't until I experienced a painful whipsaw during a tight trading range that I finally understood the importance of structure. Price had been moving sideways for weeks, forming well-defined boundaries, yet I convinced myself that a minor breakout was the start of a new trend. I chased it without recognizing the larger pattern. Hours later, the market snapped back violently, trapping me and countless others who had traded the breakout without understanding the structure. The professionals had used the apparent move to unload inventory before driving price sharply lower. That moment taught me that every phase of the market leaves a fingerprint. Accumulation builds its foundation through higher lows, reduced selling pressure, and controlled volatility. Distribution reveals itself through failed rallies, increasing supply, and subtle weakness that shows up long before the trend reverses. Markup and markdown phases, though dramatic, do not appear out of nowhere. They are simply the expression of structural preparation that took place quietly beforehand. When you train your eye to read these patterns, the market shifts from chaotic to highly organized. Support and resistance stop being arbitrary lines and become turning points based on real underlying forces. Springs, upthrusts, tests, breakouts, and breakdowns are no longer unpredictable. They are natural structural events that occur repeatedly because they serve a purpose in the market's campaign. Each one is a clue. Each one is a signpost. Together, they form a map you can follow with clarity. Most traders lose, not because they lack intelligence, but because they ignore these structural messages. They enter too early during accumulation, exit too late during distribution, or chase trends in the middle of extended moves. The market may look random, but it follows a logic rooted in the interaction of supply and demand. Structure reveals that logic before price confirms it. Once you learn to respect the architecture of the market, your trading transforms. You no longer feel lost in the noise. You begin to see where you are in the campaign, where the pressure is building, where the trap is forming, and where the opportunity lies. Structure removes confusion, it removes unnecessary emotion, and most importantly, it gives you a map that guides you through the market with steadiness and precision. One of the most powerful truths I've learned in the markets is that the greatest profits rarely belong to the trader who moves the fastest. They belong to the trader who observes the longest. The market rewards patience with clarity, while impulsiveness is punished with confusion. Most traders believe action equals progress, so they click buttons all day, jumping from one opportunity to another, chasing noise, reacting to every twitch in price. They forget that the market reveals its intentions slowly, often quietly, long before it delivers a dramatic move. And those who are willing to sit still long enough can detect the early shifts that separate the ordinary trades from the transformative ones. There was a period early in my career when I equated productivity with frequency. I believed that more trades meant more opportunity. I would enter positions at the first sign of movement, terrified of missing out, certain that being early was synonymous with being right. But time after time, those rapid decisions put me directly in harm's way. I would buy just before a distribution phase, sell just before a markup, or exit just before a climactic reversal. It felt as if the market waited for me to act before showing its true direction. The truth was far simpler. I was acting before understanding. I was trading impulses instead of observations. The market does not reveal its next move in a single bar. It reveals itself through subtle transitions, slowing momentum, quiet absorption, failed attempts to break levels, or increasing hesitancy near prior extremes. These signs are small, easily overlooked by traders seeking excitement. But the observer notices. The observer tracks how supply behaves as price approaches support or how demand responds near resistance. The observer waits for tests, watches how volume behaves during reactions, and studies how spreads change during moments of pressure. The observer understands that money is made not by predicting, but by recognizing when the conditions are right. There is a rhythm in every campaign. Before an uptrend begins, the market often goes through a calm period, volume contracts, volatility narrows, and the chart appears dull. Impulsive traders abandon these areas because they find them boring. Observers study them, knowing that the quiet often precedes force. Before major markdowns, distribution leaves unmistakable clues. Rallies weaken, supply increases, and upward progress becomes labored. Impulsive traders interpret each rally as a new beginning. Observers recognize them as tests, traps waiting to spring shut. Patience is not inaction, it is active analysis. It is the process of gathering evidence until the market's intention becomes clear. When you cultivate this mindset, you stop feeling pressured to act. You start waiting for the market to confirm what you already suspect. You allow the structure to develop. You let the story unfold. This discipline leads to trades that feel effortless, not because they are easy, but because you entered them at the right moment, when the market aligned with your understanding. The market rewards the trader who listens longer than others, who waits for the quiet signals that precede the big swings, who values clarity over excitement. When you become that trader, you stop chasing opportunities and start capturing them. And that shift from impatience to observation is what creates consistency, confidence, and long-term profitability. In the end, everything we've explored comes back to a single truth: the market is not chaotic, unpredictable, or unknowable. It is structured, intentional, and deeply repetitive. It speaks clearly to those who know how to listen. The recurring patterns, the relationship between volume and spread, the unfolding narrative behind every move, the architectural phases of each campaign, and the subtle signals that reward the patient observer, these are not separate ideas, but parts of one unified skill, the ability to read the market's mind. Most traders lose because they react to the surface, chasing noise while missing the deeper message. But those who train their eyes to see the preparation beneath the movement, the logic behind the structure, and the quiet footprints left by strong hands gain an advantage that compounds for a lifetime. When you stop forcing trades and start understanding the market's language, you transition from struggling against the market to working with it. And once you can do that, once you can read intention before reaction, story before breakout, cause before effect, you no longer trade with hope, you trade with clarity, confidence, and the calm certainty that comes from mastering the very patterns that have guided the market for over a century.